What is up, guys? Welcome to another episode of The Real Build. I'm your host, Bill Reiman, your broker builder. And today, I got a very special guest, longtime friend. This guy and I have known each other for a long time, since high school. We were just talking about how old we are getting due to Jay's high school graduating year. Jay hasn't even seen his 10-year reunion yet. I'm going on 20, not to age myself, but anyway, Keith Embree is here today. How you doing, man?
Good, man. Yeah, I guess the good news is we don't feel that old.
Yeah,
but it's like before you know, we're pushing 40. It's like, geez,
yeah,
where'd the time go?
Yeah, man. I think if you think you're old, that's when you start to get old. So as long as
slowing down a little bit,
yeah, as long as we feel young, we'll be good.
Totally.
Right?
We'll go with that.
Yeah, we got to just keep the young looks going, right?
We'll go with that.
So Keith is with Raymond James Financial. So we're going to talk everything financial, everything that you guys should be doing on the investment side to basically, be better with your wealth in general, right?
Yep. It's building wealth, and I think more importantly, like I always try to shift the perspective of our clients from it's not just your portfolio that you're investing in, right? That we're helping you invest in. It's like my goal is to grow my client's net worth. It's a lot more than just your portfolio. It's your total net worth.
Yeah.
And that's how I have always approached it, because it's really just about comprehensive financial planning and investment management, just managing the portfolio. That's like a prerequisite these days. That's just the tip of the iceberg if you're doing it right.
Yes, we're going to have a lot of information today. I got a good feeling about this one because this topic is something that a lot of people do not get into until it's too late, in my opinion, and sooner is better. So before we get into it, you guys know the routine: like, share, comment, subscribe. Go on YouTube, check out all the past episodes. I'm back this week after the girls did a great job. Shout out to them last week. Sorry to disappoint you that it's me this week, but excited about this episode. Jay, let's kick it off. The Real Build is about building better culture, leaders, visionaries, community to better serve the client. I'm your host, Bill Reiman, your broker builder, and I'm here to showcase real business owners building companies with integrity, trust, and a commitment to making a positive impact. Join us as we explore their stories, insights, and strategies for success. With that being said, welcome to The Real Build. So before we get started, let's talk a little bit about you, how you got into the financial world. You and I have known each other since high school and before high school too. And just talk about that a little bit, your background, so people know.
Yeah, for sure. So went to college at Florida State University, was big into sports growing up as a kid, played tennis for the men's tennis team at FSU. That kind of shaped me, so to speak, as a kind of a young adult trying to find my way in the world. Graduated 2011, going back to your point, not to date yourself. Scary saying that. Graduated 2011, kind of still fresh off like the recession, the Great Recession. So job market was rough. Fortunately found like a very entry level marketing job at Raymond James in 2012, and just kind of rolled with it once I got my foot in the door. And that was kind of the goal, just get my foot in the door, get a job, get a big boy job, so to speak. And let's just see where it takes me. And fortunately, Raymond James is a great firm that promotes like internal movement, especially for like their younger workers. So that was something I tried to take advantage of. I tried to move around the firm, see what I like to do. So, fast forward 13 years later, over the course of those years, I ended up obtaining my certified financial planner certification. That's kind of like the coveted, I would say most respected certification in our industry of wealth management. Then also got licensed, and we need various licenses as well, and those aren't a piece of cake to kind of pass. So focused my time on that while kind of keeping the full-time job at Raymond James, and decided to pursue being a financial advisor years ago, and have been loving it, doing it ever since.
If I could go back, especially like to college and stuff, I wish I would have paid more attention to the financial side of things too, man. It's like you don't think about it, especially being younger, being in your 20s. You're really not thinking about the investments and stuff. I made a lot of personal mistakes on investments when I first started getting into it. Like, I remember getting into Amazon and all the big names, but because of the pressure of investing, I would be like, oh, it's going down. I'd watch it too much instead of just, let it go, let it go. And I think younger generations and people in college and even in their 30s and 40s aren't really focusing on the investment side of things too. So talk about that a little bit, the importance of it. Like, when do you think they should start?
Honestly, as early as possible. And I'd even say this sounds ridiculous, but like middle school, high school, just start thinking about these things. And I wouldn't be so hard on yourself, Bill, because I think some of it's like the school system.
I agree.
Just like the school system typically hasn't made it a priority to teach like personal finance to the youth. They do a good job teaching, algebra, geometry, calculus.
A lot of stuff we don't use.
A lot of stuff that I haven't seen parallelogram season happen just yet. But I do file my tax returns every year, and I had no idea how to do that when I graduated college. So that's, it's unfortunate. There's probably reasons for that. I think the school system's, well intended, of course, but that's always, in my opinion, been kind of a breakdown. And that's something I'm passionate about, is like educating today's youth, our community's youth, around just personal finance, simple things, right? Like you're talking to a class of middle schoolers, high schoolers. It needs to just be about budgeting. What's a debit card? What's a credit card? What's credit card interest? Why is that not good? Loans, like mortgages, simple things that we shouldn't be really learning for the first time when we're 23 years old out in the real world. So, that's certainly a passion of mine. To answer your question, start as early as possible. I think everyone knows like what compound interest is and the power behind it. It's still like, when I look at some like various charts of compound interest, it still shocks me on if you invest $7,000 in a Roth IRA when you're 22 years old, as opposed to 30, you have hundreds of thousands of dollars more. It's crazy. So it's really just starting as early as possible and just getting in the habit and building like good, consistent discipline around savings.
Well, that's the thing too. It's like getting into the early start part of it too. It would have stopped a lot of the mistakes that I made, thinking that, like I went into it blind. Like I'm like, all right, maybe I should start investing some of this money. I got into real estate. I started getting commissions and I'm like, I've heard of investing. Maybe I'll do it myself. You start investing yourself, and then you're looking at it. Stocks are going up. You're like, yes.
Yeah.
Should I cash out? No, let's hold. And then all of a sudden it goes crash and burn. And then you're pulling out. You're losing money instead of just the patience of the game overall, And it's like, that's why you hire somebody like yourself to be able to be that guide, to be able to. And I didn't have that. The lady I was using, not going to say any names or companies, but she would be like, oh, yeah, let's pull it out. Every time I would say it, probably because of the commission side of things too. And it was never really any advice like, no, this is a long-term thing. You should stay in as long as possible. And I think that's where people would benefit with your advice. And going back to like the school system and teaching about money, they don't. It's like, we have math class. We know how to add and stuff like that. But as far as like financials and credit cards and stuff, like a lot of it was learned on my own, or your parents teach you,
Learn
or
through mistakes.
Exactly.
And that's sometimes the best learning. But money's emotional, man. And that's why people tend to make poor decisions because emotions are involved. And that's why it is usually in folks' best interest to have a financial advisor, because it's that kind of unbiased third party that's going to guide you through like the ups and downs. Because again, you're going through the downs, you're going through a tough market. People tend to get emotional and make mistakes. But if you have someone kind of alongside you to kind of right the ship and keep things in perspective, that is going to be in your best interest long term. It kind of goes back to I think Warren Buffett said it. It's not about timing the market, it's time in the market. And being able to stay in the market long term is really a recipe for success. The S&P 500, for example, the most common index in the country, the world, it's been up 8 to 10% a year the past 150 years. So like history proves that the market will go up over time. And I think the stats roughly are about 70% of the time the market's finishes up for the year, and 30% of the time it finishes down. So the odds are actually in your favor, but the folks struggle with the 30% time. that's when they start to make some mistakes, and that's what's going to be a lag in their portfolio longer term.
Well, I think it's the patience side of it too. I mean, we live in such a
now generation.
Yes.
We want money now. and you even touched on, you made a comment earlier about like individual stocks, for example. So that's something we should spend time on.
Yeah.
So like this day and age, financial advisors, this is borderline my opinion, but it's also kind of an industry norm at this point because the industry's evolved. But we're not stock pickers, right? Now, some advisors, maybe a strength of theirs is researching individual companies, doing like some technical, like fancy technical analysis around like PE ratios and alpha and all that crazy stuff. That's not how I operate. I'm not a stock picker, and I'd say majority of good financial advisors don't hang their hat on picking good stocks. It's more about finding low cost, like diversified investments like mutual funds and ETFs. And just trying to understand that, look, we're not trying to beat the market. We're not trying to, the market's going to market. Let's ride the market. And if the market does have a down year, let's try to minimize that as much as possible. But when you try to beat the market, more often than not, you end up underperforming the market because you're making kind of questionable moves to try to beat it. And again, I try not to focus as much on, I of course am investing my clients' money appropriately and based on kind of like what's suitable for them. But I'm focusing more on the broader picture, like tax planning, estate planning, cash flow management, expense management, lending strategies, retirement planning, education planning. The list goes on and on. But at the end of the day, you want to approach it comprehensively because everything should be connected to make it work. Because again, I'm not trying to grow necessarily just trying to grow your portfolio. I'm trying to grow your overall net worth.
Yeah.
Okay. So which encompasses a lot of other things than just picking Apple and Amazon and Google in your portfolio.
Go into that a little bit more, the importance of the long-term play of it, right? And because like with the tax planning, the estate planning, these things that, let's face it, we all kind of think we're never going to die, right? Mm-hmm. We don't have a fear that we're going to walk out the door and die. Maybe some people do, but most of us, think we're going to wake up the next day, right? So, but you don't, which causes us, I think, not to think about the long term ahead. Like somebody in their 20s, when I was in my 20s in college, I thought I was going to live forever, and would do stupid things all the time.
Yep. I wouldn't know anything about that.
Yeah, no, you not at all.
I didn't witness anything.
Yeah. So, going back, thinking about that though, it's like being somebody in your 20s. Why would you start now? And why would you worry about these things like estate planning and things like that now?
Yeah. Good question. So, there's a million reasons why like starting early is beneficial. Number one, we already touched on it. The compounding interest effect is real. But also, taxes are a big deal. I do want to spend some time on taxes.
Yeah,
taxes are, I think folks are used to, maybe you file their taxes on TurboTax or maybe you have a CPA. The more wealth you have, the more big of a deal taxes become. Not just because your marginal tax rate starts to increase, but taxes can really drag your portfolio. It can drag your portfolio down. And so making things tax efficient is really important, especially, and if you start healthy habits early in doing that, that's how you can really start to compound some serious wealth. But again, it really just goes back, Bill, to building good habits early. So I mentioned Roth IRA earlier. If you only need earned income to have a Roth IRA. Mm-hmm. That's so if you have a job, you can open up a Roth IRA right now with Raymond James and contribute up to $7,000 a year to that. It's not a ton of money. People are going to think, oh, well, I'm trying to build real wealth. What's $7,000 going to get me? Go on a compound interest calculator, do $7,000 a year for the next 30 years and see, and at a 5% to 8% return, which is really conservative, and see what that Roth IRA looks like. You're going to think you typed in something wrong on the calculator. The number's going to be huge. And that's tax-free money, for example. Like we look at Roth IRAs as like king/queen of savings accounts. So it's starting those types of things early and not just putting money in a savings account in cash and it's sitting in cash making 0.0%. So it's, I think just taking a step back to answer your initial question about like how can you incentivize people to start early? These things are important now, and you don't want to be, 40, 45, 50 and start prioritizing these things, because you said it earlier, it's just too late at that point. So although like estate planning may not be super applicable to someone in their 20s or 30s, you still want to have like foundational elements of like an estate plan, for example, in place. Wills, power of attorney, financial power of attorney, healthcare power of attorney, perhaps a revocable trust if you have, call it $1 million, $2 million net worth. So it's really just, again, putting foundational elements of a wealth plan in place earlier rather than later, instead of playing catch up in your 40s and 50s.
You talked about making things more tax efficient. Let's go deeper into that a little bit because of the importance of that. Like, are you giving advice on that aspect of it? Because a lot of people, like you said, rely on the accountants, and I think it's important on your side as a money manager that is talked about more too, because you might have different strategies than what the accountant is saying too.
Yeah. So I could spend all day talking about taxes. I love taxes for some reason. I don't know why. I never thought it would resonate.
Well,
with
because
me.
We all don't want to pay the government as much as we're paying.
Right. And there's a lot of strategy that you can take advantage of as it relates to taxes. So in a prior role at Raymond James, I worked for a business where we had a tax business on the side. We had a tax LLC, and we had 2 CPAs that were filing returns. They weren't necessarily client facing. They simply kind of executed the tax returns, but we as the financial advisors we did the tax strategy essentially. And there's so many things you can do to save income taxes and state taxes, frankly. Like I'd say half of my clients are not in the state of Florida and are subject to state tax. In Massachusetts, California, New York, those are very high state tax rates. And so there's like some big strategies you can do to really save money on that front. But it really comes down to like diversifying. I sound like a broken record because I think everyone's heard this, but diversifying your portfolio, it doesn't just mean diversifying your investments, but it means diversifying the types of investment accounts you have. Some are going to be tax advantaged. Some are going to be like after-tax investments. Some are going to be maybe only dividends are taxed. So you want to make sure you have like different levers to pull based on whatever situation you're in life.
That's the thing with the whole tax side of things too. Like a lot of it overall, even with the money side of things too, there's not a very good understanding of it. And when you get into even the estate planning side and the importance of that too, I think that's like backtracking here. Like I never realized the importance of having somebody good by my side that knows finance, knows money, like yourself, right? And then I've learned, but then I want to get into too what I'm getting at is like finding somebody that is trustworthy, right? Let's get into that, because I've gone through a couple financial planners, lost some big money by one of them. Not going to say a name, although I should call them out. But a lot of people by this specific person got screwed too, just on the life insurance side and that whole, and you probably know what I'm getting at. There's just a lot of untrustworthiness in the financial world too. So how does somebody pick the right person, find somebody like yourself? I know Raymond James is a huge company, so I'd probably start there too, because I don't think they're just going to hire some schmo off the street.
Yeah, you want to have a reputable firm.
Yep.
So that's like for starters. But I acknowledge, like, if I don't have any investment, if I put myself in the shoes of a prospective client, if I have no investment experience and I'm kind of a novice to just financial planning in the investment world, I'm going to be intimidated, and I'm not going to know where to start to find a financial advisor, because when you don't know what you don't know, then you can easily be taken advantage of, right? And I'd say start with a reputable firm, but then educate yourself on what questions to ask. And there's a slew of information online that will help you in framing questions that you can ask a prospective financial advisor that is going to kind of put them on the spot, which is what you want to do, and you have to, and as a financial advisor, as long as they're like fairly honest and answering those questions honestly, then that person can have a pretty good idea of how they operate. Now, I mean, it just happened to me the other day. I had a prospective client, and that was in real estate actually. She realtor, does a great job, has a lot of potential, high net worth already, has multiple properties, and didn't know a ton about my world, but you could tell before she officially engaged, she sent me an email with like 10 bullets of questions, and they were all really good questions. And I appreciated that she did that. She asked what my fees were, how I get compensated, why she should be joining me, essentially, like what benefit is that to her? And I appreciated that she did that. Fortunately for me, I mentioned I'm a CFP professional, so we're held to a fiduciary standard. Fiduciary means we always have to put the client's interests first before ours. And that's what's tough in our industry. It's like there's so many embedded conflict of interests that just come with the job. And so there's certain like maybe insurance oriented wealth firms that you perhaps may have touched on earlier and didn't say names where and I don't want to just pick on those firms, but I tend to see it more with firms that kind of center their business model around life insurance and annuities, because those products tend to have the higher fees.
That was the first thing they pushed too.
Right. And so whenever you're talking about higher fees, it tends to be the financial advisors, taking those higher fees, and they're incentivized to push products that are going to kind of maximize the fees for themselves. Yeah. Now, for us at Raymond James, we operate, first of all, we don't have any proprietary products. You'll never see like a Raymond James mutual fund, Raymond James life insurance. We use Fidelity, Vanguard, all the providers. So we're not incentivized to sell any proprietary products, which is big. And we also we hold ourselves to a fiduciary standard, as I mentioned, and we're really making sure that we try to strip all the conflicts of interest out of the process that we have. So one example of that is we operate on a fee-based or model for the most part. I'd say some advisors do some commission business still. So commission, just to back up, when you sell a stock or buy a stock, that's going to generate a percentage of commission for the financial advisor. I don't do really any commission business. It's all fee-based. So what's fee-based? It's basically I'm charging a percentage of a fee on the assets that I have under management for you. Okay. So if, let's say I'm managing just using round numbers, $100,000 of your money, Bill, and I'm charging 1%, that's $1,000 of fees. Now my only incentivization at that point is to grow your account, because that means my fee's going to grow. So it's structured to be, if my client's doing well and I'm investing the portfolio soundly and it's growing, then I'm rewarded in that as well. And that's kind of a healthy relationship.
What you should be, yeah.
Right. So that's my belief in how things should work. Now, unfortunately, as you mentioned, some folks don't always kind of operate like that.
Yeah. I can go into that even more, but due to time, I want to hit all these different directions. Yep. Talk about investing as early as parents investing. I've heard about this. Yeah. It's really not put out there enough, I don't think, like investing in your kids early, right? Starting with them, what accounts are possible for new parents.
Yeah, I love working with new parents. I'm one, just had a daughter a year ago, and with a baby, a new child, comes opportunity and things that you really need to get on top of. And so to answer your question, there's really 3 accounts you can look into when you have a child. And not all of them are going to be applicable based on if they're like 1 year old, but we'll talk about all 3 of them. So the first is a 529 plan. It's education related. So that's if you want to save for college. So if you want to help fund your child's college tuition, you really have 2 routes in the state of Florida. You can do Florida prepaid or a 529 plan. I tend to recommend 529 plan over Florida prepaid, because if your kid goes outside or to a college out of Florida, you kind of lose all the value that you saved in the Florida prepaid. You get your money back, but you could have, if you had been putting money in that Florida prepaid for 18 years, in theory, all that growth you don't get to keep, because in theory that money would have been invested into a vehicle that would have been growing at, call it 5% a year.
Yeah.
But if they go to University of Georgia, you're just getting your principal back.
Yeah.
So I like 529 plans over Florida prepaid. So that's one account. The second is what's called a UTMA. It's a weird name. It stands for like Uniform Transfers to Minors Act. It's really a fancy way to say it's a brokerage account for kids.
Okay.
So it's an investment account for kids that are under 21. So once the child turns 21 years old, they kind of take control of that account. They're owners of that account. But that's always I like those a lot because A, they have some tax advantages to them that adults don't have with their accounts. And then B, it establishes good habits with kids. So like I envision for my daughter, once she's like, call it, maybe 7, 8, 9, starts to like understand what money is and how it works, starting up one of these accounts for her and having her pick like a stock or two every year. And then maybe like quarterly, we look at it and say, hey, look, Emma, look at how the stock went up or look how it went down, and start getting her like familiar with that concept of saving in the market. I think that can go a long way, especially if you're starting at like 8 years old.
Yeah.
And then the third is a Roth IRA. I mentioned it earlier. Need earned income for it. So obviously Emma at 1 year old isn't working right now, so doesn't have a ton of earned income. But for example, Bill, your kids, you can employ them once they're at a certain age to your company, get them on the payroll. They've earned income, and then you can contribute up to $7,000 max or up to their earned income, whatever's lesser.
That's another thing like a lot of people don't think of, and it's not mentioned enough in my opinion too, is like, that whole growth for your kids and their future growth too. And just the college side of it, man, it's so important too. I want to go into, kind of wrap this up too. What about the business side of it for business owners? What should they be looking for?
Good stuff. So a lot of that's centered around taxes.
Yeah.
Taxes are, I can't stress enough how much of a focal point taxes are in wealth building, especially for business owners. So, as you've seen this already, like, first of all, you want to structuring your business, like what entity to choose is really important. You could be an S Corp, you could be a C Corp, be a sole proprietor, and those all have different tax implications. Obviously, you want to partner with a CPA that does actual strategy and isn't just filing the return. And, I think, unfortunately, this isn't the bash on CPAs. There's plenty of good ones in Southwest Florida. But there are some CPAs that simply they're too busy and they just file the returns. They're not incorporating any strategy around trying to save their clients taxes. And so, like, what is strategy? So, CPAs should be really focused on, like, what deductions are applicable. Depreciation for certain businesses is also really important. So they should be taking, like, a really close look at, like, how can I save my client money in taxes or defer taxes as long as possible until there's an opportunity down the road. So with business, whenever I hear what are business opportunities, it always comes back to taxes for me. And then of course, for the older business owners, you think about succession planning and what does that look like? Doing a business valuation, perhaps structuring like a succession plan with a junior partner. Equity ownership if they want to incorporate that. Those are all really important things as it relates to small businesses. I'm
gonna have to bring you back, but last question, because there's so many that I mean, because this is such a huge topic, man. You brought up, we talked about them finding the right person and so on, trust, all these things, and that question goes into why should they join you as a financial advisor?
I think because I think I've come across this podcast so far. I'm a nerd. I get pretty technical with things. I have pretty deep technical knowledge with a lot of concepts. As I mentioned, we had a tax business, so I have a line of sight into taxes more than the average financial advisor. I kind of have CPA knowledge, but I'm not a certified
which is huge
public accountant. But I'd say I approach everything comprehensively. The industry's changed. I don't want to repeat myself, but 30, 40 years ago, we used to be called stockbrokers because we did one thing, and that was trade stocks. And that was because the technology wasn't what it is today, and people didn't have access to trading platforms and the stock exchanges like they do now. If I said, hey, Bill, you should be my client, I can trade stocks for you, I mean, like, what value is that? There's no value there. You can open up a Robinhood account right now and do that yourself.
Yeah.
So I'm never going to hang my hat on just investment management. That's the tip of the iceberg when it comes to what value I can add. It's really everything else. Of course it's investment management, and I'm going to do that well and soundly, but it's everything else that we talked about: tax planning, estate planning, cash flow management, insurance planning, other risk management, lending. I mean, I could name 30 more things. And if I'm doing my job well, I know a pretty deep level of knowledge about all those things, which I do. And then if you really want to get specialized, we have great partners like subject matter experts at Raymond James that I can also bring in when that time is needed.
I love it, man. And I can see your passion behind it too, that you actually care, because in your world too, I mean, it's such a huge thing for everybody, like money and dealing with that, and it gets personal, right? You know, and you have to really care, like you said, and have the backing like you do and the resources like you do. So love this, man. Like I said, we can go on for another hour on this subject just because there's so much to it. So you're going to come back in again.
Awesome.
But appreciate you, man, doing this.
Yeah,
this was awesome.
I appreciate it, Bill. Yeah, thanks for having me.
We've come a long way since the old days.
Oh, we're not talking about the old days.
Yeah, exactly. We'll talk about them off camera. But everybody listening, we appreciate you guys. Like, share, comment, subscribe. Share this one, too. It'll go a long way. Check it out on YouTube if you missed the live. And we will see you guys on the next episode. The Real Build is about building better culture, leaders, visionaries, community to better serve the client. I'm your host, Bill Reiman, your broker builder, and I'm here to showcase real business owners building companies with integrity, trust, and a commitment to making a positive impact. Join us as we explore their stories, insights, and strategies for success. With that being said, welcome to The Real Build.